Welcome back to the Neuro Finance Masterclass. Today, on day 111, we construct the ultimate salary machine of the stock market. We're diving deep into the strategy of dividend retirement today. We're going to take all that complex market data you've been looking at and translate it into a highly strategic, totally empowering blueprint. This is all about you taking back control, right? We are building a lifelong, passive cash flow engine that literally works for you while you're asleep.
Just to let that really sink in, welcome back to the Neuro Finance Masterclass. Today, on day 111, we construct the ultimate salary machine of the stock market. Think about that for a second. We aren't here to gamble. We're definitely not here to play some stressful guessing game with the stock market. No, we're here to act as architects. By the time we finish this explainer, you're going to have the precise tools to transform your portfolio from a source of daily anxiety into an automated fortress of wealth.
Okay, let's dive into this. Our blueprint today covers 5 core phases. 1. The passive cash salary. 2. Defining the yield trap. 3. The security blueprint. 4. Building the drip engine. And finally, 5. The income audit. Phase 1. The passive cash salary. So yesterday, on day 110, we mastered quantified market psychology, right? We looked at how emotions completely drive market cycles. Well, today, we're shifting our focus back to the traditional stock market. We're moving away from the abstract, right into tangible, cold, hard cash. And the crucial point here is understanding this massive, fundamental shift in mindset. You see, the amateur speculator, they live in a state of constant anxiety. They buy a stock, wake up sweating, frantically checking their phone, just hoping the price goes up tomorrow. That is a miserable way to build wealth. The architect, though, the architect views their stock portfolio like a highly productive farm. Look, if you own a farm, you don't panic if the theoretical value of your land drops by 2% on a random Tuesday, do you? You don't care about the daily weather fluctuations. You care entirely about the size of the harvest. We want corporate fortresses paying us a permanent, compounding cash salary, rain or shine. Phase 2, defining the yield trap. But listen, before we can start planting seeds and building this machine, we absolutely have to understand the exact math. So first, what exactly is a dividend, or as we call it in Turkish, temettü? It's actually really simple. It's just a portion of a company's corporate net profit, which remember, we covered extensively back on day 106, that the board of directors actually chooses to return directly to you, the shareholder, in cold cash. It's your reward for being a part owner of that business. No tricks, no abstract theoretical value, just cash deposited right into your brokerage account. Now, to measure how powerful that cash payment actually is, we look at the dividend yield, or temettü verimliliği. It's a simple formula, really. You take the annual dividend per share, divide it by the current stock price, and then multiply by 100 to get a percentage. This formula is absolutely vital. Why? Because it translates a flat cash payment into a measurable percentage return on your investment, which lets you easily compare entirely different stocks. Now, what's really interesting about this, imagine you see a massive number, like 18%. For an amateur, an 18% dividend yield looks like an absolute gold mine. They're thinking, no way, I'm going to make an 18% return in pure cash this year. But as an architect, you must never, ever chase the highest number blindly. Honestly, if a company is offering an 18% yield, alarm bells should be ringing in your head. Because a yield that high, it's almost always a yield trap or temettü tuzak. It is mathematically temporary and, quite frankly, highly toxic. Remember the formula we literally just looked at? Yield is the dividend divided by the stock price. If a company's business model is dying and investors are fleeing, the stock price collapses. And when that denominator collapses, the yield percentage artificially skyrockets. You aren't finding some hidden gem, you're stepping onto a sinking ship that's about to slash its dividend to zero. Phase 3, the security blueprint. So, to audit a company's safety and completely shield your hard-earned neurofitness from those catastrophic dividend cuts, you have to look at the dividend payout ratio, temettü ödeme oranı. This tracks the exact percentage of net income a company actually distributes to its shareholders. You just divide the total dividends paid by the company's net income. This metric is a game changer. It tells you immediately if a company is recklessly giving away all its money, or if it's being smart and saving some for the future. Think of this metric as your survival guide. A payout ratio between 30% and 60%, that is what we call the sweet spot. The company is paying a really healthy cash salary to its partners, which is you, while retaining enough cash to reinvest in R&D, upgrade their infrastructure, and compound future growth, something we drilled into on day 68. But you've got to pay close attention to the danger zone. Anything above 80% is high danger. If a company distributes almost everything it earns, it leaves zero buffer for economic winters. This total lack of reinvestment is a massive trap. Literally one bad quarter, one supply chain hiccup, and they will be forced to cut that dividend just to survive. Now, the only exceptions here are real estate investment trusts, or REITs, and utility companies because they have different legal structures. But for a standard corporation, a ratio approaching 100% is just a ticking time bomb.
Phase 4. Building the drip engine.
All right, now that we know how to find safe, reliable dividends, it's time to weaponize them. It's time to reach your freedom number, that very specific target we calculated back on day 82. The elite path to true financial freedom requires focusing on the number 25. This number represents dividend aristocrats. We're talking about operational monopolies with absolutely bulletproof EBITDA margins that haven't just paid a dividend, they have increased their payout every single year for at least 25 consecutive years. Think about that for a second. Think about all the economic crises, the recessions, the massive market crashes over the last quarter century. These incredible companies raise their cash payouts through every single one of them.
And this brilliantly illustrates how we turn those aristocrats into an unstoppable machine using a dividend reinvestment plan, or DRIP. Here's how it works. Step 1, you receive your cash dividend. Step 2, instead of spending it, you use a DRIP to instantly and automatically buy more fractions of that exact same stock. Step 3, your overall share count increases. And step 4, because you now own more shares, your next dividend payment is even larger. This compounding math turns completely exponential. Your shares literally buy more shares, which pay more dividends, which buy even more shares. The absolute beauty of the DRIP engine is that it accelerates your timeline to full retirement entirely independent of market volatility. If the market crashes, well, your dividend cash just buys more shares at a cheaper price, turbocharging your future income.
Phase 5, the income audit.
This is where theory meets reality. It is time to hand over the actionable keys so you can implement this strategy today. Here is your cognitive task. I want you to pull up your current stock watch list or your existing portfolio. Stop staring at those short-term, daily price candles. Just stop. Instead, identify which of your companies actually pay dividends. Find their dividend yield, but whatever you do, don't stop there. Cross-reference that yield with their dividend payout ratio to ensure they are sitting safely in that 30 to 60% sweet spot. Finally, check their historical payout growth over the last 5 years. Are they actively raising their dividend, or is it just stagnant? It's time to build an automated dividend matrix that actually works for you.
I want to leave you with this stark final question to really ponder. Are your holdings sustainable cash cows, or are they fragile traps just waiting to collapse under pressure? It's time to audit your investments, reinvest the harvest, and truly rule the cycle. Thanks for joining us on day 111 of the Neuro Finance Masterclass. Get to work on that income audit, and we will see you next time.